Welcome to the Think Tank. This is our first podcast episode, and today we're going to be having a look at sort of the finance side of medicine and how to get started in investing. So things to look out for when you're investing or saving money as a medical student and doctors down later on the track. So today, as you can see, we have a special guest, also my classmate. He is a postgraduate student doing first year med at Bond. He has a BCom degree.
Yes.
Yeah. Yep. And he also works as an
investment analyst.
As an investment analyst.
Yeah, an asset manager.
And you can see I don't know too much about finance.
Yeah.
So we're just going to have a bit of a chat, and this is going to be in a series of videos. So just a disclaimer, we're just having a bit of a talk. So this is not like actual financial
This isn't
advice.
personalized financial advice. It's general. It's all general in nature.
Yeah. So it's all general. So
let's get into this.
Let's get into it.
Let's do it.
So first of all, the question that I have in mind is what is sort of finance? We'll start there with real big picture.
A very high level.
Yeah.
So finance is quite a broad term, but I think for us, we need to sort of think of, finance, we can think about it with concepts of sort of money, like at a very simple level. So obviously money is, the currency that we're using in everyday life to purchase things. But as medical students, we don't tend to really think about finance a whole lot.
Yeah.
It's something that's kind of, we may think about the cost of our degree, we may think about the cost of sort of purchasing things, but we don't really necessarily think about how our actions with money will impact us long term. And that's something that you kind of learn a little bit more about in a finance degree, and having that experience, having that background, I have kind of learned about how my actions with money will affect my wealth over time. I think that's probably the most relevant part of finance to us.
Yeah.
It's more personal finance and wealth building, and the important thing is putting those steps in place and doing the right things now as students will really be advantageous in the long term for our wealth and for our saving ability.
So let's get into a bit more about that. So you said kind of putting steps into place as students.
Yeah.
So how would you recommend on starting that kind of journey?
Yeah, so the best way, there's a few good ways to build wealth.
Sure.
There's a lot of things you can do. You can simply just, obviously work and save money, putting it in a bank account.
Not the option for us.
Not really an option for us. Maybe if you can work part-time.
Yeah.
That's a way to build wealth. Save your money and don't spend it. You're growing your net wealth that way. You can also invest in assets, certain asset classes. So you could invest in purchasing a house. Again, not really an option for us. You could purchase cryptocurrencies. You could purchase shares or equities, which is the most common and easy way, in my opinion, to build wealth at our age and to build wealth over the long term. So as students, if we start thinking about these things now as an 18-year-old or 19-year-old or 20-year-old or however old we all are, I'm a bit older. If we start thinking about these concepts now, it really benefits us in the long term, because the longer you're in the market, the more cumulative total returns you receive over your holding period or investment period.
Yeah. So I think kind of delving more into sort of the share aspect that you talked about, which you said was the easiest.
Yes.
Having looked at shares and stuff myself, I'm so confused as to what they really are.
Yeah.
So do you want to just give us a quick crash course on what a share even is?
Okay, so a share is a unit of ownership in a business, right? And it's a unit of ownership in a business which is public, which means it's listed on a stock exchange. It's publicly listed. Anyone, no matter who you are, can go and purchase a share in that business. A private business is a business which is not listed on a stock exchange. So that's a company that you can't easily just go and purchase an ownership stake in. So when you purchase a share, you're technically an owner of that company. you're a part owner of that company, and that gives you certain rights. It gives you rights to potentially dictate how, in a small way, how the company's run, but it also gives you rights to certain things like dividend payments, which are essentially payments of profit that the business makes on a year-to-year basis. But a share is, depending on how well a company performs, it actually impacts the company's value as a whole. And that will impact what your shares are worth. So by investing in companies that continue to perform well and grow their returns and earnings over time, so does the value of your individual unit of ownership. It becomes worth more. It's more valuable.
Yeah. So I'm just having a think, and so we're trying to buy these shares.
Yes.
How do we buy them?
How do we buy them?
It's all great to know what a share and stuff is, but if we can't get into the market,
how do we buy them?
Yeah.
So what we have is you have these, I guess, companies called brokers. There's a few. In Australia, big ones like CommSec, all your banks like NAB, Westpac, ANZ, they have share trading platforms. You can create an account, and it's essentially, think of it like a bank account. It's just an account you log into, you have an app on your phone, and you can just go in, search for a stock that you want to purchase, and it'll keep it there in the brokerage account, and it will track its value. So you can see how much it gains or loses on a particular day, how much you've gained or lost in the position since you bought it, and you can sort of track changes in your portfolio over time in this brokerage account. Of course, you can buy more, or you can sell the holdings that you have as well when the share market is open.
Right. And is that, so through banks, is that the only way to do it?
So the big banks have brokerage portions of the business, but there are also other players like CMC Markets, Stake. There's a few other little sort of companies that you can choose from. I recommend to all investors to go for the one that offers the cheapest brokerage. Some of the more traditional ones, like bigger ones like CBA, NAB and whatnot, they'll charge you $20 a trade, but you can go with some smaller players like Stake is a really good one, and they only charge you $3 for a single trade. So
kind of expanding on that, is there a difference between like the smaller ones and the bigger ones?
There can be. So some are in the Australian share market. We have some which are CHESS sponsored, which essentially means, it's a bit hard to explain, but essentially the ASX, the Australian Stock Exchange, has a registry of people's like ownership in shares. And if it's CHESS sponsored, then you're registered with the ASX as being the beneficial owner of the shares. Whilst if it's custodial ownership, and this is kind of getting a bit more complex, but if it's a custodial broker, the broker's the registered owner of the shares, but you just have an account with them where you're you're the designated owner in the broker's eyes, but like on the official exchange, they're the owner. Yeah.
Right. So those are the kinds of two different.
Chess is technically less riskier in the Australian context, not international, because they don't have chess. It's just an Australian thing, because chess is if the broker or exchange was to, I don't know, go out of business, doesn't really happen, but if it did happen, then you would still be the owner of the shares no matter what.
Right.
Whilst if it's custodial and the broker goes out of business, there's potentially risk that, you know, you may not have your shares technically allocated to you. Yeah, it's a bit of risk there.
Bit of risk. Okay, that's really interesting.
But Stake is like, and this isn't a plug, but Stake, they offer $3 CHESS sponsored share trading. So it's really cheap way to buy and sell shares, and it's CHESS sponsored. So much cheaper than CommSec, which offers $20 trades.
Wow.
Yeah.
Yeah. So, and you'd recommend kind of just shopping around and seeing what they offer. What they offer,
whether they're CHESS sponsored or not, in the Australian context, because US shares are going to all be custodial. And essentially what the cheapest is, because you want to pay minimal transaction fees. You don't want to be paying transaction fees, excessive transaction fees, because they limit your returns. right? If you have excessive transaction fees, you're paying a percentage on your total investment. So it over time will limit your returns.
Right.
Compared to lower.
So something that just sort of struck me was, is there a reason why they have higher transaction cost?
It's simply for profit. Yeah, people pay it. Back in the day, you'd have to call someone to buy shares.
Yeah.
And, those days fees were quite high, and they've just kind of continued on those sort of higher fee things. But in the industry, there's been a lot more competition, and that's put downward pressure on brokerage fees. And so now it's becoming cheaper, which is really good for us as investors, because we're not having to pay exorbitant fees to buy and sell, which is good. Okay,
so cool. So what we've found out was the best way to start sort of earning a decent amount of income, even if you're not working, is through investing.
Yes and no.
Yes and no. There's a catch.
No. So when you talk about income, some shares pay what we call dividends. So dividends are a portion of profit paid out from the business.
Okay.
Not all companies pay dividends. So when you're investing, you really need to define your objective. Okay. So is your objective to receive income? Is your objective to obtain capital gains and capital growth? For younger people, it's typically the latter. Whilst for older people in the retirement phase, they're more so focused on actually deriving an income from the investment portfolio. And there's a reason for that. Obviously, if you're in your 70s and 80s, your lifespan's more limited at that age. But also, they typically have quite a lot of money accumulated to the point where they can derive quite a good amount of income from it. So, to get like a normal salary, I guess, of like, let's say $60,000-$70,000 of income a year in a portfolio, you need to have quite a lot of money invested. You need to have, in the hundreds of thousands, $500,000-$600,000 plus. So most investors with smaller balances, whilst everyone wants dividends, they're not really focused on deriving income. It's more a focus on actually obtaining capital gains and growing their portfolio over time.
So it's like a side hustle.
I guess
kind of.
I look at it that way. Yeah, I look at it that way, definitely. And on the positions in my portfolio which do pay dividends, it's important to reinvest all those dividends because they will expand your returns over time.
Right.
Whilst for people, as I said, in the retirement phase, they may actually want to use that money to live on. Whilst for us, our objective is, at our younger age, is to grow our portfolios and really expand the amount in them, I guess. More so, for whatever we want to do down the track, whether that be buy a house or
a car,
whatever it may be.
Or a watch.
Or a watch. Could be a watch.
So that's really interesting. So kind of moving on, what are the common pitfalls?
Yes. So there's a lot.
Just why don't we give the top 3 common pitfalls?
God. How would I think that through? So let me just maybe, I guess, try and move on to, I'll answer that question, but we'll talk about maybe I'll kind of flip it and say in how people should invest, particularly medical students. And I'll kind of explain the pitfalls in that. So we've defined what a share is, and we defined what it does. It's a unit of ownership in a business. Now, let's give an example, Apple, right? I can go buy a share in Apple. It's a share in a business. The problem is that when you buy, let's say we buy a share in Apple, or we put money in Apple, the fortunes or the amount of money that you're investing, the value of that is tied to the fortunes of Apple, right? So in doing so and investing in Apple, you need to have an understanding of how Apple is going to perform as a business. Now, if you're a professional investment analyst or even hobby investment analyst, and you have the significant time to devote to that and the resources to devote to that, it's not a Herculean task to kind of figure that out and do your own research and ascertain what the prospects are of a company like Apple, certain business. we're not really in that position. We're not fortunate in that position. Being med students, we're time poor, and the time that we do have is really devoted to studying and building up our medical knowledge. So that's a problem, because if you don't understand the business and you don't understand its fortunes, then there's a lot of risk in that position.
Yeah.
So one of the common pitfalls of investing is just simply buying something you don't understand.
Yeah, investing in something that you don't understand.
Yeah.
Like what Warren Buffett said.
What Warren Buffett says. It's about the circle of competence. Invest in what you know.
Yeah.
Now, there's actually a certain class of shares called ETFs, exchange traded funds, that help us with this. So what exchange traded funds are, think of them like they're like a type of share essentially, but instead of buying one share of Apple, let's say, you're buying one share of the entire Australian share market.
Okay.
Or the entire US share market.
So it's all spread out.
Yeah, so within one share you might have 200 different businesses.
Okay, yeah.
Right, so think of it like a sort of one share, and there's a proportion of a lot of different businesses in each. Yeah.
Okay, yeah.
And what we're doing there is we're not betting on the fortunes of one company, but we're betting on the fortunes of multiple companies.
Okay, yeah.
So what we're actually doing is we're obtaining diversification.
Yeah, you're spreading all your eggs in different baskets.
Exactly.
Yeah.
And in finance, we say diversification is the only free lunch that you obtain in finance.
Yeah.
Because there's an old saying, there's no such thing as a free lunch. I think it comes from, I remember looking up the origin of this. I think it was like back in the 18th century in France or something, they would give bar patrons free lunches if they bought a certain number of drinks, right? And they think they're getting this great deal because they're getting a free lunch, but they're not really getting a free lunch because they're buying the drinks, right? Yeah. And it's the same thing in investing, and bring me to another pitfall. If something sounds too good to be true, it likely is.
Yeah.
So with an ETF, you're getting diversification, and that means the fortunes, or I guess your money, is not just tied to that single company, but it's tied to a whole host of different companies.
Yeah.
So what that means for us is it means that we don't need to necessarily do that research and know that business that we're investing in, because we're not betting on one company. We're betting on the entire market as a whole, right?
Right. And
so when we talk about risk, and I'll define risk as the risk, I define investment risk as the likelihood of you losing capital, losing the money you invest.
Yeah.
There's two components. There's systematic, which is market risk, and idiosyncratic, which is firm-specific risk. And when you invest in an ETF, you diversify, you're only exposing yourself to systematic or market risk, and you're getting rid of that firm-specific risk. You're completely eliminating it almost.
Okay.
And so by investing in that type of product, you're essentially lowering a risk, and you're only exposed to wide and all-encompassing market movements as a whole.
Yeah.
For example, COVID pandemic affecting the share market, or GFC affecting the share market, or Trump getting elected, I don't know, whatever it may be.
Yeah.
It's a general movement across every stock, essentially. That's a systematic or market movement.
Okay.
Yeah.
Cool. Thank you so much for your time.
Good.
Thank you for giving up your valuable time.
No worries.
I'm sure you have places to be, so do I. So we'll give it a quick wrap.
Yeah.
So we've given us a lot of information today, and if you need to rewatch the video, go do that.
Yeah.
Again, we'll have you back very soon.
Yes.
We'll see you every day, so
yeah.
you'll definitely be back. So yeah, that's a wrap. Hope you guys enjoyed that. If there's any specific details that you want me to cover in the next part of the series, do reach out to me and let me know, and I'll pass it over to Jordan. And so yeah, cool. Bye.
See you guys later.